Ladies and gentlemen, good day and welcome to the Sterling Tools Limited Q4 and FY'24 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pankaj Gupta, Group CFO. Thank you and over to you, sir.
Thank you. Good morning, everyone. Thanks for joining this morning. On behalf of STL Group, I extend a warm welcome to our Q4 FY'24 earnings call. I'm joined on this call by Mr. Atul Agarwal, our Managing Director, Mr. Jaideep Wadhwa, Director, Mr. Anish Agarwal, Director, and SGA, our Investor Relation Advisor. We have uploaded our results presentation on the exchanges, and I hope everyone had a chance to go through the same. I will now request Mr. Atul Agarwal for his opening remarks.
Thank you, Pankaj. Good morning to everybody. I welcome you all to our Q4 and FY'24 earnings call. Let me start with a brief overview on the industry. The Indian automobile industry demonstrated resilience and recorded a satisfactory performance in FY'24 amidst a backdrop of robust economic growth. According to SIAM, the industry showcased a growth of 12.5% in domestic sales compared to the previous fiscal year. The passenger vehicle segment led the growth trajectory, with overall sales touching nearly 5 million units, including 4.2 million in the domestic market. During the year gone by, we have reported top line of 613 crores at the standalone level, while our 100% owned subsidiary Sterling G-Tech E-Mobility, which is the largest motor control unit manufacturer in India, reported remarkable performance. The revenue generated by SGM grew from 174 crores in FY'23 to 323 crores in FY'24, a substantial increase of 86%. SGM now accounts for 35% of our consolidated revenue, up from 23% in FY'23. Furthermore, we are excited to announce that Sterling Tools has entered into an MOU with South Korea's Yongan Electronics to establish an EV components facility in India. The strategic partnership is anticipated to generate business of around 200 crores per annum in the next 5 years. This venture marks a significant stride towards advancing the production of electronic components in the country. Against this backdrop, the board has approved investments in 2 companies, namely Sterling E-Mobility Private Limited and Sterling Tech Mobility Private Limited, transforming them into wholly owned subsidiaries of Sterling Tools Limited. We have announced segregation of chairman and managing director roles in order to provide greater focus to electric vehicles and other green technology verticals. In line with our succession strategy, we have also initiated role transitions, elevating members of the next generation to assume expanded roles and responsibilities within the company. We are optimistic about the future of our company and our industry. We believe that our focus on innovation, customer service, and operational excellence will continue to drive growth and profitability in FY'25. I request Pankaj to give a brief insights on the financial performance.
Thank you, sir. I will now give the financial highlights for Q4 and FY'24. We'll start with standalone numbers. Total income for Q4 FY'24 witnessed a growth of 5.2% year-over-year and 17% quarter-over-quarter, and it stood at 167 crores, whereas for FY'24, total income increased to rupees 614 crores. EBITDA for the quarter stood at 25.6 crores, which is a growth of 21.3% year-over-year and 20% quarter-over-quarter. EBITDA for FY'24 stood at rupees 90.6 crores. EBITDA margin has improved from 13.3% in quarter 4 FY'23 to 15.3% in quarter 4 FY'24, and overall year's EBITDA stood at 14.8%. Profit before tax, before exceptional items, witnessed a growth of 41% year-over-year, 37.6% quarter-over-quarter, and stood at rupees 16.1 crores in quarter 4 FY'24. For FY'24, profit before tax, before exceptional item, was 52 crores. Profit after tax came in at rupees 12 crores in quarter 4, a rise of 126% year-over-year from 5 crores in the corresponding period last year. For FY'24, profit after tax stood at 39 crores compared to 41 crores in FY'23, and exceptional item was 3.4 crores in FY'23. Coming to the consolidated financials, total income at a consolidated level increased to rupees 270 crores in quarter 4 FY'24 compared to 202 crores in quarter 4 FY'23. This is a growth of 27% year-over-year. For full FY'24, we have reported a growth of 21%, reaching to a turnover of 938 crores compared to 775 crores in FY'23. For quarter 4 FY'24, adjusted EBITDA stood at 33.8 crores versus rupees 23.4 crores in quarter 4 FY'23, a growth of 44%. For FY'24, we have registered 15.8% growth year-over-year to rupees 116 crores versus rupees 100 crore in FY'23. The adjustment is on account of ESOP expenses worth rupees 2 crores. Adjusted EBITDA margin stood at 12.5% for quarter 4 FY'24 compared to 11% in the similar quarter last year. For FY'24, adjusted EBITDA margin stood at 12.4%. Profit before tax, before exceptional items, increased by 60% year-over-year and stood at 21 crores in quarter 4 FY'24 compared to 13 crores in quarter 4 FY'23. For FY'24, we have witnessed 20% year-over-year growth to rupees 71.8 crore versus 60 crores in FY'23. Profit after tax for the quarter increased to rupees 16.3 crores compared to rupees 7.8 crores in quarter 4 FY'23. For FY'24, we reported profit after tax of rupees 55.4 crores versus rupees 47.9 crores in FY'23. Please note that there was an exceptional item of 3.4 crores in FY'23. Thank you, everyone. We may now begin with question and answer session.
Thank you very much. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deepan Shankara Narayana from Trustline PMS. Please go ahead.
Good morning, everyone, and thanks a lot for the opportunity, and congratulations for a strong set of numbers. So firstly, from my side, so what is the kind of investment we are planning for this new MOU, and what kind of margin profile these products can reach at full utilization?
Anish, you want to take that? Are you there?
I think the kind of investment we're looking at is of the magnitude of 20-25 crores in the first phase.
I'd just like to clarify that's the plant and equipment, not including land and building.
Correct.
Sorry, Anish, go ahead, yeah.
Yeah, so without land and building, just plant and equipment and machinery, that's around 20-25 crores in phase 1. With regards to the margin profile, we're still doing our feasibility studies, by talking to various customers. And once we have completed that, we get a better picture of what kind of margin structures this business will entail here in India.
Okay. Yeah. And this MOU, should this help us in achieving new clients for MCU products in the PV space? As well as, do we have any scope for potential future addition or extension of new products from this MOU?
Yeah, so this MCU is not in the MCU space per se. It's a different product category called magnetics. It will only add to our kitty of EV components and subcomponents. It will definitely increase our pack price and our value with various customers, both OEMs and tier ones.
Okay. On the EV business overall, so we have initially targeted 8 to 10% kind of EBITDA margins. Full year we are around 7%, but for past 2 quarters we are around 5 to 5.5% only. So what are the challenges we are facing in maintaining this run rate, and when we can expect this to reach 8 to 10% level?
So I'll take that question. I think these numbers that we talked about for the last quarter are really adjusted EBITDA numbers, and this is due to ESOP cost that got loaded at an operating level. There is no degradation in the margins. We will definitely see an improvement in margins in the coming year, and we continue to make progress towards our stated goal of 10 to 12% EBITDA margins in this business in a steady state.
Okay. And also on the MCU side, what is the visibility on capacity expansion side, since our revenue run rate already crossed 400 crores on Q4 basis? And also, what is the plan on fastener side? That's also around 80% kind of utilization.
So I'll answer the question on the motor control units, and then request Atul to address the question on fasteners. So we have been able to ramp up volumes to meet our customer requirements. So as of today, we are consistently producing more than 2,000 units a day. This is not, but that takes us to about 600,000 unit capacity for the full year. And we actually hope to be able to de-bottleneck and improve process flows, further to be able to optimize output. So the expansion is largely in place, but there is still some, I would say, finishing touches that need to be executed on that plan.
So let me take it up for the fastener business. As you've seen, we had a very muted growth in our fastener business. We're probably up only 2% in our revenue numbers in FY'24 over 23. I think we are, so, we see with the capacities we have in place, including our Bangalore facility and some maintenance capex and capacity enhancements happening to balance out the equipment, we don't need substantial capex in the fastener vertical. Having said that, in earlier calls as well, I think we can reach a revenue of between 750 crores to 800 crores with the capacities and the maintenance capex coming through at Bangalore plant. So in the short term, we don't see any huge capex needs or any capacity issues. We just need to ramp up Bangalore and balance that plant. So I hope that answers the question.
Yeah, thanks. And lastly, from my side, in the press release, we have mentioned that the change of roles to provide greater focus on electric vehicles and other green technology verticals. Can you please throw more light on this perspective?
So what we, as you've seen, our EV component of our business was 23% of our revenue. of our consolidated revenue in FY'23 has gone up to 35%. We're going to put, our intention is to strengthen our fastener business going forward. We want to strengthen our fastener business, keeping in mind our margin expectations we have for ourselves, and we want to focus on high-value parts only. We want to put a lot more capital, both in terms of financial resources and human capital, into our new initiatives in EV ecosystem and new energy systems and green energy systems. So that's our focus, and I think if you see post our HM success, we have announced our first thing on magnetics with a Korean company. There are some other projects in the pipeline. We are doing some market studies, technology identifications, and hopefully in the next 6 to 12 months, we'll probably get more visibility into specific products and technologies we are focusing on. So broadly, capital allocation and human resource allocation will substantially go into new businesses in the areas mentioned.
Okay, thanks a lot and all the best. I'll join back with you.
Thank you.
Thank you. The next question is from the line of Mumuksh Mandlesha from Anand Rathi Institutional Equities. Please go ahead.
Thank you so much for the opportunity, sir, and congratulations on the new partnership. So firstly, on this new partnership, can you help understand a little more on the product side? What is this magnetic basically used for, and what are the application areas in autos and non-autos, and what kind of content per vehicle is there in the sector?
Are you able to address that? You want me to do it if you're not up to it?
No, I'll do it. So magnetics is essentially components like transformers, common mode chokes, EMI filters, and inductors. So basically, wherever you're transforming current, either you're reducing the voltage from a higher voltage to a lower voltage, then you're using a transformer. So these are components which are used in automotive as well as non-automotive industries. Our partnership will predominantly be for the automotive space to begin with, and specifically in the EV space for components like chargers, both onboard and off-board chargers, battery management systems. So these are the building blocks which form these subcomponents that go inside an electric vehicle. That I think with regards to pack price, we're still doing our study and we won't be in a position to comment on the pack price per vehicle these components.
Okay. And just to understand, how would be the localization scenario for this kind of product in India? Would be one of the first in this space, sir?
So there are very small companies which are doing trading in this business. Some companies are manufacturing also, but at a very small scale, because the core raw materials here in India are not available. Just like in MCUs, semiconductors, etc., are not really localized in India. There are certain components in these magnetics which are not available in India, for which we will have to depend from overseas suppliers to get those subcomponents.
Okay. So how would be the partnership between the Yongin and us? Would be any JV formation, or it would be a technology?
Yeah, so it will be a JV structure post our feasibility studies are completed. Yeah.
And since we are talking about the 20 crore investment, any timeline by which the plant would be ready, sir?
I think it will be 2025 calendar year, sometime there. Okay. Sometime towards the second half of 2025.
And so since Yongin has a very strong base with Korean customers, do we have any sense of order visibility from them?
Yes, so I think the anchor customer for them is the Korean OEMs, and we have some visibility on the orders for the Korean OEMs taking off from 2025 second half onwards till the latter half of this decade. On top of the Korean ecosystem, Korean OEMs, we're trying to add more customers, which could be the Indian OEMs, the Indian tier ones, the MNCs present in India.
So then what we mentioned about 200 crore potential, basically that kind of order visibility we have for the Korean customers.
No, so that's factoring in not just the Korean ecosystem, but also the market sizing we have done from the Indian OEMs.
Got it. And just lastly, on the fastener side, this year the growth has been lower than the industry growth versus the underlying industry growth. Any reason for the slightly underperformance versus the industry?
So, if you look at our customer portfolio, and you look at the automobile industry, bulk of the growth in the automobile industry has come in from passenger vehicle segment. If you look at the segments of commercial vehicles have been flat or probably slightly negative. Farm equipment has been negative. Second segment which grew was a two-wheeler segment. I think that two-wheeler segment is roughly up 7-8% in volume itself. So we have done in both the segments of passenger vehicles and two-wheelers, we are working with market leaders like Maruti Suzuki primarily and Mahindra Automotive Division. We have signed some business now last year with Hyundai, but that to get any material revenue will probably be more like a calendar year FY'25 or a financial year FY'26. And same thing in our two-wheeler business, where bulk of our revenue in our two-wheeler business comes from HMSI, and we added Hero MotoCorp as a customer again about 18 months ago, which is bearing good results, and we are finding growth in that. So I think it's a question of customer portfolio profile. We need to strengthen that in PV and the two-wheeler segment, which is what we are working on. On the CV side, we work with all the customers in India, and there has been, like I said, CV segment did not really grow. We had a lot of business we did with Mahindra Tractor Division and John Deere. John Deere is roughly 30% negative in revenue, and Mahindra itself is about 11% negative in volumes as well. So, it's a combination of things. Some aspects where our customer portfolio needs some strengthening, at the same time weakening in some of the customer segments in FY'24.
Got it, sir. Just based on since you have across the segment diversification, how are you seeing the outlook for next year by the OEMs? What kind of growth they are talking about, sir?
So our sense is two-wheelers should again have a healthy growth this year. I think it'll probably surpass the peak number of financial year 18-19, where the industry saw all-time high numbers. We expect two-wheelers to be strong this year, and we also expect passenger vehicles to be strong again this year, riding on that SUV growth in India. So I think these two segments will continue to grow. Vis-a-vis tractors, farm equipment, and commercial vehicles, our sense is it's not going to be it won't be a strong year either. It'll be very much on lines of last year. Farm equipment may not degrow to the extent of 10%. Either it'll be flat or marginally negative. Commercial vehicles will again be range bound within flat or within a couple of percent plus minus.
And our growth should be outperforming the industry soon?
Well, like I said, we are addressing our customer portfolio issues. Overall growth, yes, will be in line with industry if you add up all the all the segments put together. But we may lag something in passenger vehicle side because we only work with Maruti, like I said, substantially, and our two-wheeler side where we substantially work with HMSI. So those two segments will grow much faster in the total our industry, and we will grow, but I think our overall numbers will be very much within industry growth numbers on a gross basis.
Thank you so much for the opportunity.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Apurva from BugleRock. Please go ahead.
Yeah, hi. Thanks for the opportunity. Am I audible?
Well, if you can be slightly closer to the mic, it's a little muffled.
It's better now?
Much better.
Yeah. So, thanks for the opportunity. Just wanted a couple of questions. Can you help with the volume growth in the fasteners segment and also segment-wise, if you can, just help? Yeah.
So
For FY'24, yeah.
So I think like I said, our growth has been marginal this year, 1 or 2%. Our volume growth is also similar. So what you see in value growth and volume growth is very similar lines. There were raw materials that stabilized, so the factoring in of steel movements is not there. So volume and value growth have pretty much on similar lines.
So broadly similar. Okay. And segment-wise, if you can just share some numbers in terms of volume growth for FY'24. Yeah.
So I think in two-wheelers we were up 7%.
This is volume growth.
Sorry?
This is volume growth for 24, right? FY'24.
Yeah. In two-wheelers we are up 7% in FY'24 over FY'23. In passenger vehicles, we were negative 10% over FY'20. Sorry, I'm reading the wrong number. So sorry. Yeah. So once again, let me go from the beginning. In passenger vehicles, we are up 7% in revenue. In two-wheelers, we are up 21% in revenue over FY'23.
So just sorry to interrupt. Just wanted volume growth and also,
So similar. Like I said, there has been no price increase in fact on these values. It's very similar within a range bound of maybe 1% plus minus.
Okay, so you can please carry on there. 10% in 7% in PVs, right?
7% in PVs, 21% in two-wheelers. In commercial vehicles, we were negative 11%. And farm equipment, we were negative 17%.
Okay. And also, if we, what are we doing sort of to increase our market share further in the fastener segment, right? What some of the steps you can highlight?
So I think keeping in mind our strengths and keeping in mind our customer profile, we want to focus on growth, but we want to focus on healthy growth. Growing at a very fast clip will make us take some commercial decisions on pricing, which we are very averse to. So we want to focus healthily. We want to focus on our margin structures, which we have, and we keeping all that in mind, we'll probably be growing at the rate of industry growth, say 10-12% a year on an average.
Okay, so right now market share would stabilize at around some current levels because.
Correct. I think Yes.
Okay, and one last question from my side. So we, in a way, you have addressed, Yongin has Korean OEMs as anchor customers, so there is some visibility over there. So would we be supplying these components to like Hyundai and Kia, the bigger ones out there, and any royalty that would be paying to Yongin, just in any other time, just trying to understand here.
Anish?
Yeah, so we will be looking to supplying not only to the Korean OEMs in India, but also the Indian OEMs, whether Tata, Indra, could be other Japanese OEMs also in the future, and their tier one supply chain also. That's what we intend to do. What was your second question again? Sorry.
So Yongin, royalties, any royalty for, this?
Yeah, so this will be a JV agreement. It will not be a technical licensing agreement with equity from both partners.
Okay, so it will, there's nothing on that side right now?
Yes.
Okay. Yeah, thanks for the opportunity.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Ayush Agarwal from MAPL Value Investing Fund. Please go ahead.
Good afternoon, sir. I hope I'm audible.
Yes.
Thank you. So, my first question is on the MCU business, if you can give us the volume numbers for FY'24.
Yeah. So,
About nearly 400,000 units for the year.
All right. Sir, continuing on this question, I was checking the EV two-wheeler numbers for FY'24, and we have grown around, like, on a pan-India basis, around 35%-38%, while our MCU business has grown more than 80%. So if you can help us understand how we have been able to gain such a high market share, and, what led to this?
So in a part of it is the fact that the customers that we have been nominated by are the ones that have the highest market share. So as our customers have grown, we have grown with them. And even in the newer markets of three-wheeler and LCV, we have a strong presence through the nominations, or the volumes there are not as significant. So that's the key driver for volumes for us.
And in the top three, two-wheeler customers that we have, what will be a wallet share roughly?
Look, in the two-wheelers, on the two-wheeler side, you said, right?
Yeah, EV two-wheeler side for the MCU business.
So the wallet share on EV two-wheelers is, about 8 to 10%. Or 8 to 12% on average, and then when you get into three-wheelers, it becomes lower, and when you get into light commercial vehicles or heavy commercial vehicles, then it goes lower still. So the highest number is for the E2-wheelers, where it is 8 to 12%.
Sir, I'm not asking on the margin, but like our market share with our customers for the MCU business.
No, that's what I'm saying. You asked me what is the share of wallet, right? That was your question. So what I'm saying is that if a vehicle is being sold for 1,00,000 rupees,
no, sir. I get your answer, but for my question it was that if customers are buying 100 MCUs, how much are we supplying to them, our top three customers?
As of today, all of our customers, we are 100%. Single source.
Oh, wow. Okay.
So for a given model, and I'm talking not one specific customer, I'm talking all of our customers across all product categories and across all segments of the market. As of today, everyone that we are selling to, for that model, we are the single source.
That's great. So second question on the MCU business is, what are our gross margins for this business, let alone the EBITDA margins which we want to target, but what are the gross margins here?
We average, I think we've discussed this in the past, we average about 30% gross margin.
30. Understood. Okay. So my final question is on the partner business. I'm new to the company, so please pardon my ignorance. But when I look at our, capex investments in the standalone entity, which is the partner business, we have invested about 250 odd crores in the last 6 years. There would be, of course, some maintenance capex. And yet, incrementally in FY'18, we did a 90 crores EBITDA on a standalone basis, and last year we did a 85 crores EBITDA. So incrementally, whatever we have invested has not yielded us anything yet. So what are your thoughts, to one, grow this business, and two, go back to a margin level where our ROC justifies the investments that we have made in the past?
Good question. So I think it all boils down to revenue growth. We have done substantial investments in the last few years in setting up a new facility in Bangalore. And I think when you set up a greenfield facility, there's a lot of infrastructure you need to build from scratch, which takes a lot more capital and time to do it. Yes, there's a lot of capital behind it in the last few years, and we have to optimize that capital investment into revenue, which we'll see in the next couple of years coming through. And automatically, when that revenue kicks in, it will help our ROC numbers as well. So you're right in every way that we need to optimize growth in our fastener business, which is what we are trying to work on right now. And we expect to see growth this year as well as next year, which will change our cost structures, our margin structures, and return on capital. On the last point you touched about margin structures, I think our margin structures are hovering around 15%, give or take a few. And I think we keep talking about numerator-denominator effect over the last few years. Our basic cost structures, what we had in the last 4 or 5 years, are on very controlled lines. The margins have substantially shown a decrease mathematically on account of steel price increase, which we have got from our customers, but we have not been able to get any price increase on account of value addition or conversions we do on top of the raw materials. So it's a simple mathematical calculation. I'll request Pankaj, the CFO, to reach out to you and explain that in more detail on a one-to-one basis.
Done. That was a helpful answer, sir, and I hope we achieve that growth and our targets there, because then our numbers will start showing up very well. So final question is on, in the partner business itself, you gave us the growth in each of the segments. If you can also give us a split of these segments, of how much was two-wheeler, passenger vehicle, commercial vehicle, and farm in the partner business.
I didn't get your question. You want to repeat that question? You're slightly muffled.
Sure. So in the partner business, if you can give us the split between the different passenger vehicle segments, two-wheeler and commercial vehicle segments of our partner business.
Revenue-wise, Pankaj, you want to say that?
Yes. So, passenger vehicle for FY'24 was 27% of the total, two-wheelers 24%, commercial vehicles 22%, farm 13%, the retail and aftermarket 12%, and 2% export. That's the revenue segment. Yeah.
Thank you. That's it from my side. Thank you.
Thank you. The next question is from the line of Sonal Gupta from HSBC Asset Management India. Please go ahead.
Yeah. Hi, good morning. Good afternoon. Thanks for taking my question. So just wanted to understand what's the outlook for the EV business for next year. Given that we've seen substantial growth this year, how do you see on this base next year panning out?
Good morning. Good afternoon. I think I think maybe I can start by talking about the EV industry as a whole first. Despite the challenges that we have and the changes in government policy and regulations have thrown up a lot of challenges for this industry. But regardless of that, we still hope to see about 30% growth in this industry in the coming year. Having said that, I will say that April numbers were very muted for the industry as a whole. But one is hopeful that things will correct, and being privy to some of the strategies that our customers are deploying to try and circumvent some of the regulatory challenges that are there. So one hopes that 30% is a reasonable target for the industry as a whole. And as a leading player in the market today, we hope to have our growth, which is I won't necessarily say in line with this number, but at least close to this number.
Got it. And because we, like you mentioned also in some of the comments today also, right, like we're there on the three-wheelers, on the LCVs as well. So anything you see, when do you see these, are we seeing some traction in these segments, and are they starting to become more material in terms of their contribution? I don't think as per the presentation as yet, not yet, right?
I feel bad that we keep talking about this traction. Let's first actually break it up into two. The three-wheeler industry or the three-wheeler segment has seen great traction, and we've grown very well within that. We've gained market share within that area, and we've got some plans to further increase our market share there. The LCV segment, where we've been nominated by nearly all of the major players, is one that we keep waiting for the takeoff, and for various reasons it hasn't happened. The reasons aren't necessarily in our control or that of our customers. So we keep hoping that it's the next quarter, and unfortunately that's the only answer I can give you even now.
Okay. But on the three-wheelers, are we there with some of the,
We're there with some of the, I won't be able to name all of them, but we're there with some of the big, we've got agreements that forbid us from giving out names like this, but we're there with some of the big cargo and passenger vehicle companies.
Right. And just lastly, on the ESOP cost, could you just, for the full year, sorry, I missed that number. What was the full year number?
No, we didn't declare the full year number. We just said that there is an adjustment. This is we've announced ESOP plan, and as per accounting standards, the charge needs to be made, which is front-end loaded. I can't get into additional details on this right now. It's basically it'll basically be the big chunk of it will be in FY'24 and 25, and then we'll taper down, but that's as per accounting standards. But we won't get into further details than that at this stage.
But you've given the adjusted number, so it's roughly 80-90 bips impact. So is that the sort of impact that we should expect next year as well in FY'25?
FY'25 will be higher.
No, it also depends on the vesting of the employees as per that. So it's a combination of that, and it's a below the line number and as per accounting standards.
No, that's fine. I was just saying that if you could just quantify, then everybody would be sort of aware of that impact, right? That's
Pankaj here. So this is vested in 4 years, and as per the accounting standards, it's all accounting provision has to be done front-ended, which is about in first 2 years will go around 60-65% of the total cost. Okay, and it tapers down as we move to the third and fourth year. So so the 2 crore is the impact of FY'24 is only for the last 2 months, because we only this is 2 months impact, and the next impact will be the biggest one in the entire. So I'll just it should be around 10 to 11 crore rupees.
Okay, got it. Great. Thank you so much.
It will sit in a salary cost, but it is that's why we show adjusted EBITDA, because it is not just for a like-to-like comparison, we are showing adjusted as a revenue.
Right. So over the 4-year period, that will be about a 25-30 crore impact.
22 to 23 crore in my.
22.
And that's as of today, and it could obviously change in the future as the ESOP plan changes or other changes. But that's where we are today, and that's what we can share today.
Sure. Got it. Great. Thank you so much.
Thank you. The next question is from the line of Alisha Mahawala from Envision Capital. Please go ahead.
Hi, sir. Good afternoon. Thank you for the opportunity. Sir, like you were mentioning to the earlier...
Ma'am, can you be quite loud?
Am I audible now?
Better.
As you were mentioning to the earlier participant that the pickup in the non-two-wheeler EV has been slower than anticipation. So what is the current contribution from our top client in the MCU business?
So our top client would be what, I guess 70%, 80%? Top 7, is that your question?
Can you repeat your question? It wasn't very clear. A little louder and clearer, please.
I hope I'm audible now. The question is the contribution of the top client to the MCU business.
Top client.
Yeah, top client. About 70%.
Okay. So second question, the JV that we're doing for EV components, is it possible to quantify what will be the total capex outlay? We did mention 20 to 25 crores in phase 1, but this is our share. So what is the contribution maybe the JV partner will make, and including land and building, because it is a greenfield? What will be the total capex?
So Alisha, I'll just help Anish out here. We are at early stages right now. We're working through the business plans, etc. We don't want to give some details that may change in the future, and that's why we're also keeping land and building out of it, because that's that becomes that kind of clouds the overall investment. So we'll get greater clarity in the coming quarters. I mean, it'll take a couple of quarters for our market study and project detailing to get sorted out.
Okay, got it. Thank you.
Thank you. The next question is from the line of Viraj from SIMPL. Please go ahead.
Yeah, hi. Couple of questions. First is on the JV which we announced. In one of the comments you said that the key raw material is imported into India. So just from a differentiation of, point of view, what will drive differentiation for players in the market? And in that sense, how are we looking to approach, play in this product category?
Anish, are you there?
Yeah, I'm here. So yeah, I think firstly it's an MOU. It's not a JV at this point in time. And then from a differentiation perspective, because this is the leading supplier for these components in Korea, and for the Korean OEM, they have over 35 years of history making magnetics, wherein they started from not the auto industry, they started from the consumer appliance industry, and then they moved into the EV ecosystem only 5-7 years ago. I think the knowledge base that they have and the quality that they have for magnetics is substantially better than what is being offered here in the country, or what is being localized at this point in time in the country. So when I said localization, I meant certain key subcomponents of these magnetics, like raw materials, which are not available in India, will continue to be imported for the foreseeable future, because they inherently don't exist in India. So in terms of competitiveness, I think we definitely have some advantage over any local Indian makers who are very small in size at this point in time, or overseas makers who have not really set up any shops. It's not going to be a product quality advantage, but also a first mover advantage that we see by entering this partnership.
My question was actually on the product tech itself, right? If also look at a global level, right?
Yeah.
What drives differentiation for one company vis-a-vis others? And who would be the major competitor for them?
So the competitors for them are some Japanese tier 1 who are fairly large, but who don't really manufacture in India. They only manufacture in Japan or in the United States. So globally, competitors for them are Japanese tier 1 companies, or electronics companies, or German, Swiss electronics and electrical companies. But these companies are not really localized in India at this point in time. I think there will definitely be a cost advantage, keeping in mind these two geographies vis-a-vis an Indian-Korean partnership. And from a technology perspective, I think it's validated technology vis-a-vis the Korean OEMs and consumer appliance industry. So I think that should also give us something better than probably the other overseas makers will have to.
So maybe, Viraj, I can also just add to what Anish said, that if I've understood your question correctly, the differentiation globally on this product category comes from two areas. One is design, which comes from expertise of the applications and expertise in the market, and Anish was explaining the lineage of Yongin and their pedigree in this area. And the second part of it comes from process control. And that also putting in automation, putting in the right processes is what makes a differentiation in this. That's how different companies within this space compete against each other. Anish, have I captured that correctly?
Yeah, totally correct. I think if you were thinking about differentiation from a software perspective, that's not going to exist because it's not a software component. So it's pretty much the quality of the raw materials and the operational excellence practices that you put in place in that factory. So. Yeah.
Okay. Just a related question. Since we will be looking at a JV structure, what will be the JV stake, structure we will be looking at? Is it 50-50 or any thoughts we have in mind on that?
No, I think we still have to crystallize that. The JV equity split between both the partners. We're still working on those agreements as we speak. So we'll be only able to comment on them towards the latter half of this year.
Okay. Just one more question. This pertains both to the fastener and the MCU business. This is more on the customer concentration, right? Or to speak about customer concentration. So, if we look at the standalone fastener business, I think a year back, when we started the year, we were looking at a lot of new orders to come in. And view was that even if the market were to be subdued in some of the segments, we would outperform the industry by the margin. So what really went wrong? And, how are we looking at customer diversification further in fasteners? And similarly in MCU, right? I understand, the MCU is pick up from a market perspective. But even in e-two-wheelers, the customer concentration is still very high. So how are we going about, that?
Let me take it up for fasteners. Like I said earlier to a few questions, we are looking to grow at a very similar number at the rate of automobile industry. We have some weakness in our customer portfolio in terms of more spread in PVs. In PV and two-wheelers, we work with market leaders, but we realize we also need to have a larger stake with the number 2 and number 3 players in that segment, and which is what we are currently working on. But this will take 12 to 24 months to crystallize into any material revenues, but that's our strategy going forward. And on other segments of commercial vehicles and tractors, we have a very strong customer profile. I think those both segments showed negative and not very good numbers. And as and when they turn around, they'll obviously supplement our revenue growth. So key is we are not looking to grow very dramatically at a very large clip in our fastener business. We want to grow within the automotive industry range. We want to optimize the investments we have done, make them generate more revenue and improve our margin structure. So that's our focus, going forward in the fastener business. Jerry?
Yeah. Regarding the motor control unit business, actually, I like to think of ourselves as not only, as we move forward, you'll see our other initiatives also coming into place. But overall, we are looking at both customer and product diversification as an integral part of our strategy. Our largest customers, part of the issue was while we grew we grew with other customers, the growth that the leading companies demonstrated in 2024 or FY'24, sorry, was such that even despite the fact that we gained a lot of other businesses, the growth from some of the larger customers was even higher. So that's why we weren't able to move the needle the way we would have liked to, but I'm quite confident that this year will be different.
Okay, that's all from my side. Thank you and good luck.
Thank you. The next question is from the line of Rahil Shah from Crown Capital. Please go ahead.
Yes. Hi, good afternoon. Just on this strategic partnership with the South Korean company, you've mentioned 200 crores per annum in next 5 years. So, but when will it start? The 200 crores or something like that?
No, so 200 crores is the target, which is set based on our estimation by FY'30. And as I said, we hope to get into SOP in the latter half of 2025, beginning of 2026.
So it'll start reflecting by FY'26 then?
No, not the complete 200 crores. We'll start operations and post SOP after 4 to 5 years. We're expecting to get down to a revenue of 200 crores.
Oh, okay. Got it.
Rahil, I just, like to clarify that, in the auto industry, the validation process is very long, as you're very well aware. So, even once you start production, it takes a long time for customers to start buying in volume and to do all the validations that they need to do. So the ramp up, as Anish said, in FY'26 we definitely expect to see revenue coming in, but the ramp up will be slow in the initial years, and only once the validations are done and the adoptions are in place will we see this improve significantly.
Sure, got it. And with the consolidated level, maybe the margins, do you have any outlook there? Year on year, we've been seeing a gradual fall. So what steps you have been taking to improve them, and when will we see, a significant jump ahead?
So I think the gradual fall maybe not the right choice of words. If the product mix is changing between fasteners and between a standalone business and our subsidiary business, I think it's a mathematical issue. I think overall we are becoming more capital efficient because our new businesses are providing us a very high rate of on our investments. So on a consolidated level, in the short to medium term, we see this range bound from what you see right now at 12-13%.
Okay. And when you say across all businesses, you expect to grow, at par with the industry growth rate. So do you have any ballpark number we can, expect or presume? What is this growth rate?
Can you repeat that number again, please? The question again, please.
So when you say overall revenue growth for the company, you expect to be at par with the industry growth rate. What is this?
That's for the standalone business.
Standalone
Not at the consolidated level. At the consolidated level, we hope to grow definitely much faster than the industry.
Okay. Got it. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Abhishek Kaushinde from Sharekhan Limited. Please go ahead.
Hi, sir. Thank you for the opportunity. First of all, sir, what kind of a capex, overall capex, we are planning for FY'25?
Sorry, could you repeat that, please?
What kind of a capex we are planning for FY'25? Total capex.
What's capex plan for?
So overall, consolidated. We'll be investing about to the tune of about 60 crore rupees next year.
And that's without any investment in the magnetics business. This is only for existing businesses. That's fasteners and motor control units.
Okay. Is it a major chunk of fund is required for this MCU business, as our capacity is already reached to 6 lakh units, I suppose?
Yeah, we continue to invest a lot in tech. We are upgrading. Just to give you an idea, we have, as of today, 4 dynos for testing and validation. We are increasing that to 7. Which also we have, today the dynos are around lower power ratings. We are now bringing in some, as the commercial vehicle business picks up and other businesses come online, we are adding high power dynos. So there is a lot of investment in technology. Also some of the so, as I mentioned, some of the finishing touches on, or the finishing things on the capex haven't been done yet. So while the actual output has increased already, we haven't completed the capitalization. So you'll see more capitalization in this year.
Okay. And sometime back,
tech is the biggest driver.
Okay. And sometime back, we have been in discussion with some large players in this EV business for our MCU supplies in the two-wheeler space. Any update on the same?
No, I have nothing right now to report. We continue to engage with customers and work with them on their future programs.
Okay. And just one final question: that what kind of difference in the content per vehicle or the value of the kit for two-wheelers and the three-wheelers?
So typically three-wheelers is like, in terms of just average. So let me first explain it in terms of technical. So the two-wheelers, and I'm not talking about the low-speed two-wheelers, but the two-wheelers that are being launched today are basically using a motor control unit and motor which is between 3 to 6 kilowatt rated, and that segmentation is moving towards the lower end more. That means 3 and 4 kilowatt is going to become the predominant driver, because with a smaller motor and smaller controller, you have a lower battery requirement and therefore a lower cost. The three-wheeler requirements start typically from 5 kilowatt and goes up to say about 8 kilowatt. So the pricing also changes accordingly. So the average pack price for two-wheelers will be, say, average would be, say, 8 to 10,000 rupees, and the price for three-wheelers will be 10 to 12,000 rupees.
Okay, sir. Thank you, sir. That's all from me.
Thank you. The next question is from the line of Saurabh from Multi-Act Equity Consultants. Please go ahead.
Yeah, this is Rahul Picha here. Thank you for the opportunity. My question was on the MCU business. So in the presentation, we have mentioned that for the subsidiary, 98% revenue comes from the two-wheeler industry, and you also said that the largest customer now accounts for 70%. And you also in the previous question said that we currently don't have any business with any of the top 4 companies, excluding the largest customer. So the 28% share that is coming in the two-wheeler business, that seems pretty large for the smaller companies. So can you please elaborate, like, where is it coming from?
So we've listed out our customers, including Ampere, Torque, Simple Energy, Open EV, etc. And the other thing which I think I'd clarified once earlier is that we also sell to integrators who sell further. So therefore, there are some sales that are recorded as when they go out to, let's say we sell to a motor company who then sells as a complete kit, or to an axle company. Now those are typically going to three-wheeler companies, but those don't get reflected in the three-wheeler segment directly. We need to correct that data.
Okay, so in terms of classification, that is being classified under the two-wheeler segment, right?
Currently, yes. I am just making a note that we need to improve this classification in future presentations.
Okay, so within the overall business, like, what would be the pure play two-wheeler revenue share?
I will say, I don't have the exact number, but I will say about 90.
90. So 10 is coming from three-wheelers.
Yeah.
Okay. And on the LCV customers that you were saying that we are expecting some business, but there have been delays and it's not yet commenced. So whenever that commences, like, what kind of revenue contribution are we expecting? Can it be meaningful in terms of the current size of the business?
Look, if you the LCV business and different ways of segregating this, but if you look at the overall LCV business, including pickup trucks, right? That is a 700,000 unit market overall, in total category. It's also one of the market that is expected to see the highest level of penetration. If you leave out some of the pickups and you focus on the 1 to 3.5 ton, that's still more than 250,000 unit category. And then if you look at let's say even in initial years, even a 10% penetration, you're talking of 250,000 units to be sold, and each pack price would be, say, 60,000 rupees. So it's a significant market that we are seeing, a market potential that we see. It's just that the market hasn't taken off. You've seen some really good products being launched by Switch Mobility. Tata announced recently a new product. Volvo Eicher has been talking about a new product. It's just that these products haven't got the desired traction yet. But I'm very confident that this will be a significant contributor to our revenues.
Right. And the customer wins that we have in this segment, are they more broad-based than what it is in the two-wheeler segment?
Yes, it is.
Okay. All right. Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comment. Over to you, sir.
Thank you, everybody, for joining the call today. I hope we were able to address all your queries. In case you have any further clarifications, please reach out to us directly, Pankaj Gupta, the CFO, or you can reach out to the SJ team, and we will be happy to address all of them for you. Thank you very much.
Thank you.
On behalf of Sterling Tools Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.